Welcome to Hampshire Capital, Hampshire Diversified Real Estate Fund 1. A little bit about our team here. So Shane Carter, if you can kick us off.
Hey, thanks, Eddie. Appreciate it. So my name's Shane Carter, a CEO of Hampshire Capital. I've been in this business now for about 27 years. I started in construction development and in multifamily asset ownership. And my role here at the company is fantastic because I get to be the leader of the culture here and set the tone for how we conduct ourselves. And I also get to focus on the big picture direction that we're heading in, the big picture relationships and partnerships and moves that we make as a company as a whole to drive our growth and revenue and investor returns.
Thanks, Shane. Nick, go ahead, buddy.
Yeah, absolutely. Good afternoon, everybody. My name is Nick Bouquet, Shane's business partner here at Hampshire Capital. I've been involved in private equity and commercial real estate for over 15 years, done about $500 million worth of transactions, primarily in the multifamily acquisition and renovation and development space. And my function here at Hampshire is I work on all of our new acquisition opportunities and deal analysis. And I also oversee the operational functions of the various aspects of the company.
Thanks, Nick. Eddie Austin here. I am the Vice President of Operations and Construction. I've been in real estate now a little over 20 years, and I have been in management and over $180 million of commercial investments and construction projects nationwide, including subdivisions, multifamily, industrial, and commercial ground-up development. Brennan, take it away, buddy.
Good thing. Thanks, Eddie. My name's Brendan Manning. I come from the family office space, and I have experience working through all strategies throughout the capital stack. And I'm head of investor relations here at Hampshire. I'll be pretty active in the chat if you guys have any questions and you don't want to wait till the end. And just feel free to just click that Q&A button right there and ask away. I'll be sure to answer as we go. Also, I will be actually putting the portal link as well in the chat there, so you guys can click on that and kind of scavenge through it. And I want to offer up any opportunity to have a one-on-one conversation with you guys after this if you would like as well, to make it a little bit more personal. I can help answer any questions kind of overall suited for your investment needs. So I'll just put that in there along with my email, and feel free to just email me after this as well.
Thanks, Brennan. Also, please stick around to the end because we are going to have a special Q&A time to where we can ask any questions. So if you have questions, put them in the chat. If we can't answer them there, we will have a time later in this presentation to be able to answer all questions. Moise, take us away, buddy.
Thanks, Eddie, and great afternoon to all the guests joining us. My name is Mo LaPointe, VP of Land Acquisitions. Been involved in multiple commercial real estate transactions over the last several years. Certainly proud to work alongside a dedicated team here at Hampshire Capital. Currently, I have the opportunity to focus on delivering value creation through our land development positions nationally, and certainly we're excited to have everyone learn more about those projects.
Thanks, Moise. Michael Payne, finish us out.
You bet. First of all, thank you for joining us, everyone. Happy New Year to everyone. It's a great way to start the year and looking at real estate and the fund that we're offering. My name is Michael Payne. I'm Vice President of Asset Management. I've been doing an asset manager role with many other roles in operations, budgeting, renovations, investment in multifamily assets, as well as land for over 2 decades now. From that standpoint, I've managed a portfolio of about 7,000 units and over $1 billion in value, and I've invested in much of that as well during that time frame. So I'm excited to be here to see how on the backside, after we get these deals secured, Nick's done his thing on the acquisitions and the team has raised our funds, that I'm the one that helps keep and make sure that we're hitting the targets that we're setting as we're making these purchases. So I'm excited to be here, and thank you guys.
Thanks, Michael. So what makes Hampshire Capital unique? I am very proud of what we do here at Hampshire Capital, and I'm going to tell you why. We have an investor-first philosophy. We're investors ourselves. We have a complete alignment and transparency around capital preservation, risk mitigation, and cash flow, and total return, and also taxes. Taxes is something that you absolutely need to think about as you make money. You need to learn how to save and preserve money. And we are also on the side of helping you with that and investing in real estate and doing cost studies and cost segregations to where we can remove the taxes and try to earn you more by removing the tax liability. We're also a very neighborhood first mission company. Our priority is really on the residents, and that's a cornerstone of our long-term growth. Michael Payne and myself have spent a lot of time on our properties doing asset management and construction activities that really maintain the residents being happy and putting the neighborhoods first. Absolutely first. We care about how our residents feel about where they live. And we've had great feedback from our cities that we involved in and giving us that feedback that we are improving neighborhoods first. We are always putting neighborhoods first. We have a team of experts here. I say a team of professionals. We're dedicated to full cycle experience in commercial real estate, along with alternative assets. We've done it. We've done multiple sides of this business, is why we're able to use a method and a verbiage called diversification. Our track record, a little bit more about us. Between all of us, we have a little over 70 years collective experience in acquiring and renovating and owning, operating multifamily and commercial properties, including land development. The company was founded really to leverage the experience of our principals and identified purchase properties for the high growth in the Sun Belt markets. To date, we've transacted around $550 million and 5,600 multifamily units transacted, about 125 million in development, and 320 unit lots. Common investing fears. Man, one of the people jumped on earlier and said something about my Facebook post. And I get a lot of traction on Facebook, people reaching out. And I have a lot of people that reach out and say, man, I have some fears around investing in real estate. So that's why we put this in bold red letters. What's the common investing fears? So we kind of compiled that and we put it in the next slide here. These are the questions that I get all the time. I know that other people on the team, they get these same questions. First one is 2025 the right time to be investing in real estate? You know, we definitely have a new presidential party coming in the House. There's, new laws, new things that happen, and it puts a lot of fear and uncertainty around it. And that's one thing I'm really proud of with my team is we've done a great job of really digging in to all the new policies, and we really pay attention to the local and city and state laws and what changes in the rental markets to really understand. And we know by what we've put together and all the data-driven decisions we make that 2025 is the best time to be investing in real estate. One of my favorite sayings is the best time to buy real estate was yesterday. The next best time was today. And the biggest regret I've ever heard anyone was the guy that didn't buy the piece of real estate down the street 10 years ago because now it's a shopping center. And the gentleman that did buy it, he had massive returns off of that. It's always a good time as long as you can make the underwriting, make it work, and the numbers speak to that piece of real estate and you can make returns. Another thing, what should I invest or why should I invest in a fund versus individual properties? This is my favorite question. And here's why. I've done more syndications than I care to talk about. I'm a fund manager. I started with a fund. We have a fund here now. There's a lot of risk to investing in a single property, a single asset type, a single address. If you're putting all your chips on the table, betting on one property, there's a lot that could go wrong. And a lot has went wrong in the last 3 to 4 years. A lot of people made bets on properties. They over leveraged. Insurance went up. Taxes went up. And they had all the chips on the table on that one asset. And when that happens, it puts a lot of stress on the investors, on the general partners, and you can ultimately lose your principal by losing the property. If you're invested in multiple properties via fund, now you have diversification between the different addresses and hopefully different asset types that we're going to talk about more in the later slides. The other question is, what should I ask a fund manager before investing? Here's a couple. We're going to talk about this more. Brendan's going to have some more clarity and color on this as well. The number one thing is really, what is the general partner putting into this? Everybody needs to put skin in the game. We invested our own money into this fund, so we put skin in the game. And if you have a investment that you're looking at and you probably want some advice on what you should ask that sponsor that has this investment opportunity, how much money are they putting up and how much skin do they have in the game? That's definitely a question I would ask. Our executive summary here. This is a multifamily, outdoor hospitality, and land development. This is a $50 million fund. It's a 10% preferred return, and it's a 20 to 28% average annualized return, and it's a 5 to 7 year hold period. Most of the things that we're going to talk about today, you're going to see that this is kind of the return metrics, how we think about this fund and the deals that it's going to approach. So everything we're going to talk about today really falls right into the bucket of what we're talking about with the returns. And then the 5 to 7 year hold is a little bit long for what we're going to talk about today, but you have a good sense of security that we have that hold period there. Another thing I want to hone in on, and I've got another slide a little bit later on, about no fund level fees. We really want to pay attention to no fund level fees, and I'll tell you about that why in just a few minutes. So this is really an alignment with interest for investors. Nick, would you like to talk through this slide?
Sure, I'm happy to do so. Within the fund, we've actually structured 4 different options for potential investors to pursue. And as Eddie alluded to in the prior slide, we're targeting that 20 to 28% average annual return. And that's really, but it goes up, again, it ranges from 20 to 28%. And that's really a function of whether the investor is a class A, 1, 2, or 3, or 4 investor. And you can see in the chart below, essentially, we are incentivizing investors who make larger commitments to the fund with more fund economics. So as the investments increase in the fund, your actual share of our promote and profits actually get diluted and are passed more back to the LP investors. And so the base case example on the Class A is, again, that 20% annualized return, 2x equity multiple. Again, we've structured this to give investors options for better potential returns and incentivize larger investments.
Thanks, Nick. All right, so fees. Anybody that knows me well knows that I love educating. These are the most common fund level fees. And here's a couple fees I wanted to point out. Just number 1 and number 2. There's definitely a lot more than this that you should pay attention to. The number 1 thing that you will see is like the 2 and 20 model, they call it. And it's kind of like that's a performance fee. That's on number 2. So the first one is like the management fee. It's the management of the assets. It's assets under management. That can definitely have an impact on your returns relative to the capital that you've invested. So you want to pay attention to that. The next thing is a performance fee, and it's incentive alignment. It's usually a 2 and 20 model, but some of these hurdles can be 6 to 8%, and it really affects returns. So for instance, for an example, if an investment generates $10 million of profit, $2 million of that goes to the fund. And then the next 8 million gets distributed. So that can really erode the profits of the LP's investment very quickly, especially if it's not openly disclosed, which it should be. So little words of advice, always, and I mean always, read your PPM, your private placement memorandum, and make sure that you understand the fees and the waterfall structure. The preferred return, the waterfall structure, any hurdles, and make sure that you understand it. And if you don't understand it, please reach out to your investor relations person that's taking care of that fund and understand the fees and how they're paid. How are they promoted? How are they getting paid? Everybody needs to make money. You want to make sure that your money at risk and you're getting your full return that you should. Go ahead, Nick.
Sure. So want to just talk through, so the fund is a balance of 3 different residential asset classes, and that's multifamily, outdoor hospitality, and land development. And we picked these particular 3 assets for a very specific reason, really 2 very specific reasons. 1, this all falls within our realm of expertise. And 2, we've designed the fund in a way where the majority of the fund will be allocated toward multifamily to provide essentially a balanced foundation for the fund's returns in terms of cash flow and appreciation. The outdoor hospitality play is more of a high cash on cash yield, slightly higher risk emerging opportunity in the space. And then finally, the land development, lot development aspect of the fund is a no cash flow, but high total return opportunity for the fund. And so, this is how we're getting the fund returns to that 20 to 28% AAR is, where the blending in the additional cash flow from the outdoor hospitality and the additional total return from the land development opportunities on top of that stable return from the multifamily.
Absolutely. Thank you. Shane, take us away, buddy.
Okay, so our investment framework is really about first understanding the macroeconomics and understanding where we are in the data from a big picture perspective. We like to call it, are we in the right stream? And what we know about that is we're undersupplied in housing on a dramatic level. And so we know that we're in the right stream relative to being a housing company, a housing focused company, both in multifamily and in the 3 tiers of the fund that Nick just explained. Our strong partnerships are really key to what we do and how we conduct ourselves. So whether that's with our institutional equity partners, the property management firms that we engage with, or some of our other operating partners, like in the outdoor hospitality assets, we pick best in class operators and partner with them. And then we turn them over to Michael Payne, who manages them extremely well and ensures that they're hitting our metrics. We don't just hand it off to them and say, oh, well, they're best in class and I'm sure they'll do a fine job. No. We inspect what we expect and we follow the details, and we are extremely hands-on and proactive in what we do, which ties to the active management on the far right of the slide. That is how we conduct ourselves. That's how we ensure that all of our investments are successful, is that we're extremely hands-on. We're in the nitty-gritty and the details every single day. Risk mitigation is paramount. My money's in this right alongside yours. A lot of us on the team have money invested in this. Preserving capital is paramount. It's step one, never lose money. Step two is, carefully and intelligently grow that money. And so our risk mitigation process is extremely diligent. That's really what Nick heads up, and it takes us through understanding from a conservative perspective, doing a sensitivity analysis, ensuring that we're protected in everything that we do, understanding the downside risks, understanding the blind spots, and really thinking through where could things go wrong, and then having a plan and a backup plan for that plan to ensure that we're covered in those instances. So diversification, I think Nick covered that well in the last slide relative to cash flow, yield, and total return. And then people first philosophy. So a lot of people approach this business as a money-making venture, which is fine. Capitalism's fine. But in a people first philosophy, we care more about the residents and the communities that we build. And we think about them, and we think about this is their home. And we think about what would they want? And I think about everything in the context of my grandmother. And if my grandmother lived here, how would I want her to feel? How would I want this place to look? How would I want it to feel? And what would be something that I would proud to have my grandmother live in? That's my measurement stick, if you will. And so when you do that, believe it or not, you actually get better financial returns because you care about the people that you're serving, which generally leads to higher retention rates, lower operating costs, better revenues, et cetera, et cetera. So that's like a paramount thought process in terms of how we think about investments.
Absolutely. Michael, if you would touch a little bit more on that, on what you actively do with our property management companies, and talk about resident events and stuff like that, and really how much we care. Because for the ones listening right now, really this is a business. And what you have to understand is this business has customers, which are your tenants, and you have vendors, and you have all these people you need to really take care of. And we manage this all the way down to the micro level of Google reviews. So Michael, if you'd like to touch on that real quick.
Yeah, thanks, Eddie. I think the biggest thing that I like to frame it with is think of your residents at your multifamily communities as example as the circle of life. If you're communicating, if you're fixing the work orders and the problems that are going on inside their units that inevitably show up, if you're sitting there having cocoa events on a cold day, asking them to come in, get to know you in the office, it's those type of different ways that you're touching your residents to show them that you care, that then when you need to go through and send that renewal out that has an increase that's maybe higher than they were expecting, but at the same time they're going, wow, these guys took care of me during the year, I really don't want to leave and try to go move somewhere else. So you're able to see, as what Shane was alluding to, a higher financial success because they're happy to stay where they're at because they know you're taking care of them. They also know that a lot of companies out there don't do that. And so they're sitting there going, man, I lived in a place prior to here. They didn't fix my items. They didn't call me. They didn't take care of different things. It's those type of events that happen. So we host at least on our multifamily properties, at least 4 events for residents, one each week, usually, for them to come in, meet the manager, meet the staff. And it's kind of different than what a lot of people are doing these days. Everybody's going to AI driven products and it's calling them without having a touch. And when you lose some of that connectivity with your team that's on site, you tend to lose more residents more easily because they're not bought into you. So what I've learned over doing this for more than 2 decades now is that we need to keep some level of it. Doesn't mean we don't use technology to the max and that we progress forward using it as a way to create efficiencies, but at the same time, we need to keep the core values of keeping our residents happy. It's walking the units, as what Eddie has alluded to with myself and it's going to the properties, walking them, physically seeing what's happening around on the exteriors. How are they doing a great job on turning the units and making sure that they look fantastic whenever someone's going to take them over? If we go back to what Shane was talking about with his grandmother, I do the exact same thing. It's saying, hey, would I live here? Would my grandmother, would I feel comfortable with her living here? When you approach it in that way, you know that you're investing your money in the property. You're not just paying for expenses. And I look at it as an investment in the sense of that I'm putting money into something that I'm going to get a return on. Expenses happen at a property every day. I like maximizing the investment return we get in both our people and the way we treat them, as well as how we spend our money on the property to maximize them wanting to stay and wanting to provide us more revenue in the end.
Thanks, Michael. Go ahead, Nick.
Sure. Thanks, Eddie. I'd love to run through market observations, kind of where are we seeing opportunities, what are we seeing in the market. I'm going to take this in 2 pieces. I'm going to start with our, kind of what's happened in multifamily, where we see multifamily going in 25, since it is the largest component of the fund's focus. So Hampshire looked at 250, 300 deals in multi last year. We didn't have any multi acquisitions, largely because, we don't quite feel like it's the right time to do so. Multifamily's had a very challenging 18 to 24 months. Both from a capital markets side of things, as far as what's happened with interest rates. Now we've seen a little bit of relief there, but certainly not the relief I think we'd all would have hoped to see by now in terms of where rates have landed. Historical levels of new supply hitting markets, which I think we're seeing in the data, Michael, and both in the data and in the day-to-day operations, is having a much more detrimental impact on workforce housing than I think we had anticipated. And, that's really affecting operations. And, to Shane's earlier point about being in the right stream, while we absolutely are very bullish long-term on the fundamentals of multifamily, I think until we see both the macro and neighborhood data and day-to-day operating data that Michael has his hands on every day, paint a picture for us that we're moving into a place of kind of coming out of the bottom and moving toward some optimism. We're being very cautious with multifamily. Well, we're absolutely looking at deals. We're absolutely tracking the data, but we really want to see the data sort of suggest that we're shifting into more of a positive momentum territory, to make sure that when we do decide to deploy capital into that space, we're doing it at a time where we can be at the beginning of that upswing trend. We're not trying to time the market. We're not trying to be perfect there, but I can just tell you month over month in 24, it's been a very challenging operating environment, and we haven't that inflection point quite yet. Although, Michael, I was looking at some data this morning that's suggesting we are possibly starting to bottom out on rents and starting to maybe see a turn of the corner there. So let's huddle up on that after the call. So, we're going to continue to look at multi deals and track the data. And I think, Q2, Q3, when we've started to possibly get, I think on the other side of the supply side and start to get into the summer leasing months, and we start to see some of that positive momentum come back to the market, I can see us deploying capital around that point in time. And so in between now and then, we're waiting and watching and doing our job as diligent capital allocators. Conversely, the land development, RV, outdoor hospitality business have been well positioned in 24 and will absolutely be well positioned in 25 as fantastic opportunities. We've got a land pipeline of 4 to 5 active deals at the moment, one of which we'll run through with the group here today. We're very bullish on that space, and we've got some unique ways that we're positioned to capitalize on those opportunities.
Thanks, Nick. All right, Shane, this is definitely, you have the most experience when it comes to land, and I know that this is your favorite slide, so take us away.
Thanks, Eddie. Yeah, I do love land development. I've been doing it for the vast majority of my career. And I find it fascinating because it is how communities are born. All the homes that we all live in, or if we live in communities, were first created by someone else in a thought process and in a zoning presentation and in a development plan and then in the actual construction. And so I like this creative part of this business. And I think it's super interesting. And it's the tip of the spear. It's the reason why we're chronically undersupplied, is that there aren't enough people or enough businesses actually focusing here in the entitlement and development space to be able to drive more communities into existence, especially across the growth markets. So why do we like it as an investment? First of all, total outsized returns. I mean, we have experience in these developments that are generally doing 30, 40, 50% project level returns, which is just unheard of, and they're usually in a 2 to 3 year time period. So just absolutely fantastic total returns can be achieved in this space, and you can still manage risk, which I'll talk about here in a sec. But the high barriers to entry are also fantastic for us relative to insulating against competition. So it takes a tremendous amount of experience in this industry and capital to be able to get into it. And there's a lot of very specific knowledge. It's a very niche space to be in. And so frankly, it's generally been reserved for, if you have money, it takes money to make money sort of thought process, where you can't get into it unless you have money, and you don't know what you're doing until you know what you're doing. And so I was benefited from getting into this at an earlier age and, learning it from the ground up when the stakes weren't very high. And so I really appreciate the high barrier to entry, and that we're in a unique position to serve the market in this regard. Because it is a capital intensive business and it takes long entitlement periods, and you have to really know what you're doing to be successful in this business. So the fundamentals we've talked about, we're chronically undersupplied in housing. There's not enough land getting developed. Builders have a voracious appetite for it that's not being met. They're looking to, in general, they want to see a 3 to 5 year pipeline for national home builders. And one of the top 10 national home builders that we have a relationship with recently divulged to us that they have about an 18-month pipeline, and so they're very keen to get their pipeline built up, and it's firms like ours that can help them do that. So the diminished risk profile, I believe we will dive into further in other slides, but it's really about understanding where can a project go wrong, and how, through our experience, how have we learned how to mitigate that risk. And we'll talk a lot about that, but it's primarily with understanding, first of all, do you have a viable project? Did you check off all the boxes relative to zoning and wetlands and density and environmental issues and feasibility as an initial step? Do you even know that you have a good project? And then secondly, there's the execution throughout the entire process. But then the biggest risk is, well, who's going to buy the project and who's going to actually monetize all this effort? And that's your biggest risk. So if you can control those two big risks at the very beginning and at the very end of the project, then you're just left with actually execution, which is a heck of a lot easier to manage. So we'll talk more about that, I think, in a future slide.
Absolutely. So I want to take one small segue right quick and just really hone in on, and I want people to understand that are thinking about investing in this, especially with other groups and also ours, is really understanding due diligence. And on that due diligence period, as Shane talked about, is really understanding what could come up and what costs. And without experience, you can really get things wrong. So on one of our projects that we're looking at, it has a pond in the middle of it. Well, in that pond is endangered species. And that endangered species, ultimately, we found, because of the due diligence, that was going to cost around $2 million, and there was 2 eggs for salamanders that was in that pond. So just that right there, that could be a $2 million shortfall if someone did not have the experience to look for endangered species. And just like when we invest in Florida, there's a gopher turtle, and we have to make sure that none of them are on the site. We want to maintain their habitat. We're big on land preservation. Shane's background is big in land preservation and making sure environmentally people are safe and the animals are safe. So Shane, go in on that a little bit on a lot of the due diligence we do up front to make sure that we know the known cost.
Yeah, so it's really about, again, understanding where can a project go astray? Where can it get side railed and derailed rather? And it really comes down to understanding your wetlands and what's buildable land and what isn't, what's arable land and what isn't, and what are those setbacks and environmental protections? Because in general, we don't impact wetlands. We don't try to get zoning changes to be able to impact environmental. We just stay away from them. It's just not part of what we like to do. We just don't believe in it. The natural world needs to be protected. There needs to be a balance between the natural world and the built environment. So that's critical. Then it really comes down to density and understanding, do you have the zoning in place? Do you have the density? And for a given acreage, understanding usable acreage, right? So what can you build on, what you can't, what that density allotment is. And then, what are the roads and infrastructure costs going to be to get that project viable? Those are really the key things to understand up front. And we get all of that out of the way at the very beginning before we proceed into moving forward in a contract and taking in investor capital.
So this particular investment here is a 318 lot residential development. It's single family homes, and we're doing the horizontal land development, and it's located in Versailles, Kentucky. And I'll let Shane take us through the actual in-depth detail that we do on like forward purchase contracts and underserving growth markets and stuff like that.
Yeah, absolutely. So this is a off-market opportunity, which are always the best kind. It wasn't a marketed competitive matter. We source this again through best-in-class partnerships, and we have some Kentucky guys there that we know and like, and the feeling's mutual. And so we decided to do deals together and do business together there. And that's how we sourced this deal. So the reduced counterparty risk is really about this forward purchase contract. So in this particular case, it's D.R. Horton, nation's largest home builder. And they give us a contract to purchase the finished lots. Not only that, but they give us a deposit. We usually ask for a minimum of 10%. On this one, I believe we're getting them up to 15% on the deposit. And that's based, again, on the finished value of the land. They're putting a deposit on that. That helps keep their skin in the game. That helps keep interests aligned. And it helps protect us in what I would call is the worst case scenario, which is, well, what if D.R. Horton doesn't buy it? What if they back out of the contract? And what if they don't actually close on the dirt? What do you guys do then? And we can talk about that. But the first step is, well, we've got 15% of the finished value in cash in our hands released to us and part of the capital stack. And I think we see that in a future slide when we look at how the capital stack's formulated. But that's the key part of risk mitigation right there, is we've already secured the buyer on the back end and we've got their money and they've got skin in the game. So this is an underserved growth market, suburb of Lexington, very high end area, not a lot of development. So similar to New England and some of the other places that we all know, where entitlement is a challenge and it's difficult to get things approved. And there's a lot of people who don't want development. They want it to stay beautiful green open pasture and horse communities. And so these are rare to find in this Lexington submarket. We already talked about the reduced counterparty risk. The phased acquisition is that the buyer takes lots down in phases, meaning that we don't have to build 100% of the project and take 100% of the construction risk before we receive income. And I think, again, we show this and illustrate this in a future slide. But that's a key component to risk mitigation, is that we're not allowing our expense build to get to a point where we're overexposed. We're getting their money up front, we're using it for development. And then as we're finished in different phases of expense build, they're giving us income, which then lowers our exposure accordingly. And the entitlement risk has been cleared, fully entitled, shovel ready. And that's when we'll actually close and take title and take an investor capital on this.
So this is a little bit more on the investment summary. This is 318 lots here in Versailles, Kentucky. And then you can see the development that is around this. And what I want to really point out is you have two major highways that's really bordering this property. And you've got some brown space here on the bottom of that, really in the center. That is a new home development. We actually spoke with this developer and they have no direct highway access. So we have a very highly desirable piece of land here because we have direct access to the major highway, which is Highway 60. So it brings a lot of value to the project immediately. And then we have it allocated out where we have some nice large home sites up front. So it's really a key piece. It's a place where people can come in, we can build this out, and people will have access to either new homes in the backside of this development as well. Because to actually drive into this, it's quite a task. Like you have to really look for it, probably use GPS to even get to the back of that site down here at the bottom. So the land purchase is 7.8 million. Our Hampshire Capital equity is 1.3 million, and we'll show you instantly. You're probably thinking, well, that seems kind of over leveraged. We're going to explain that on a later slide. The project cost is about 25 million. Project timeline is 24 to 30 months. And this particular project is averaging a 30% average annualized return based on underwriting, which is about a 1.6 equity multiple. This is in the Lexington MSA, strong population, 7.9 plus in growth, and continues to grow. And the total population just continues, it's 1,000, and it's really strong. You can see how close we are here to your major MSA. It's a great place, and there's tons of development going on in this green space. And really, like Shane talked about, is there's tons of horse farms here. So a lot of this green land will never be developed simply because it's in family trust and stuff like that. And they're just not going to release it. So the housing shortage is very controlled. So I'll let Shane talk about a little bit here on the forward contract side of things. Then I want Nick to go through all the numbers. So
Okay, yeah.
go ahead.
Yeah, the forward contract is really about again getting that deposit from the builder, which in this case again is 15%. And so if you look at the sources at the bottom there, you have the construction loan, project equity, builder deposit, and then the HC fund equity. And what you see there is that we have most of the equity provided by the builder, and so we only have to come up with the small amount of equity, which again keeps us in a good leverage position relative to our equity versus the builder's equity. And then the construction loan, although it looks like that's a highly leveraged product at 77%, we do have a max exposure there that never really gets past about half of that. So it's about a 50% leverage point there. And we can talk about that, I think, on in an additional slide. But I'll let Nick go ahead and take it away from there.
Sure. Yeah, I mean, not a lot to add to what Shane said, but again, with the capital stack, we've got roughly, 25% project equity in the deal, 80% of which is provided by the builder. The Hampshire Fund gap funds the rest. On the cost side of things, we're coming in at about 80,000 a lot in total costs. We've got a nice healthy contingency number in there for construction, and the financing costs really just represent the interest carry that we're projecting. And it's somewhat of a worst case scenario, as we could certainly sell through these lots faster. Same thing on contingency. We may or may not need to use any of that depending on how we structure the final bids on this deal. But this is a good representative land development deal in terms of how the capital stack will look. So, those of you who look at other deals like this with us, this is a good, good representative deal to take for now.
So here's another exciting project that again fits in our funds criteria. This is a build to rent. So this is a vertical development. So we're doing the horizontal and we are doing the vertical development as well. And we are the end owner of all of that. And Nick, if you want to run through a lot of the things that we've done here to try and really mitigate the risk, please run through that.
Sure. So this is a land entitlement deal that we had worked on. And so we have a fantastic cost basis in the land, and we have designed, as Eddie laid out, 258 build-to-rent homes, 188 townhomes, 70 single-family residences. And a couple of the unique things we've done here. So because we're managing the horizontal construction process, we've been able to mitigate costs there. And then we are actually partnering with a regional home builder to simply build the vertical homes for us. And so we're able to control costs and do some creative things there as well to drive down the basis. And that's a GMP style contract, so guaranteed max price contract. This is Crestview, Florida is in the Panhandle. It's a really interesting growth market within the Panhandle. It's about 30-40 minutes from the coastal markets, and it's seeing a lot of growth just from the general growth in the coastal areas as a more affordable option. market research has shown us that a lot of the renters in this Panhandle coastal market they are absolutely willing to travel, and they really view Crestview as an affordable opportunity for housing. Like most of the Sunbelt markets, Crestview has had a lot of new development within the last 2 years. We're catching this deal, kind of on the other side of the lease up and supply side story there. So there's 2 deals in lease up currently within Crestview that are projected to stabilize kind of Q2 of next year. And we really won't be delivering our first units until Q3. So we're going to be hitting the market at a fantastic time. Michael Payne and I have had a number of conversations with property management groups there. We've identified 2 that we're in kind of final discussions with about the project, both of which are very bullish on the Crestview and the Panhandle in general. And, we've also had conversations with the commercial broker markets. Interestingly enough, Crestview, for a 40,000 person smaller market, has really had tremendous numbers as far as absorption lease up goes, which I think just speaks to sort of the growth opportunities in that market relative to what's happening with the strength of the coastal markets. And so, through all that due diligence, we definitely have mitigated a lot of risk. We feel like we have a very unique site in a very unique market, and we happen to be hitting the market at a very interesting time.
Thanks, Nick. So here's a little bit more on the development project snapshot. This one total will capitalize at 57 million. And then we have about 42 million in the construction loan and about 15 million in common equity. And you'll see that the HC fund that we have about 1.5 million, and then the LP investment is coming with our equity partner. So that's the total capitalization on the common equity is the $15 million. And then also the return on cost on this one is about 7.3%. It's about a 2x equity multiple. So Mo, if you'd like to take it away, I know you've done a tremendous amount of work on the acquisition side, understanding housing demand and where we are with this project. If you'd mind sharing that with us.
Sure, and I know Nick alluded to some of this, and thanks again, Eddie. Yeah, in addition to total return to capital, I mean, we all, when we look at land opportunities, we look at those opportunities through the lens of delivering local residential solutions, right? This mitigation and really collaboration among local municipality decision makers and stakeholders. Yeah, so in this pocket, there's a tremendous opportunity to deliver housing needs of, whether it be from airmen from the Air Force Base locally, right, through Elgin, right, or the Shoal River Ranch employment driver in terms of workforce housing needs. I think this BTR opportunity really provides really a rental product that's above market, and as Nick alluded to, the timing couldn't be greater, right? So we do continue to see housing pressure relative to new supply and really attainable rental, right, against sort of that non-coastal market of the area, right? Again, Nick alluded to this earlier, we see that inflow from more that coastal area to locations such as Crestview. So from that perspective, we do think this opportunity is right for attainable housing rental for the local workforce.
Thank you. A little bit more about the location summary. You can see we have some major brands here pretty close to the property. It's a 34-acre parcel, almost 35 acres. And the medium household income is about $50,000. And then your medium household value, I want you to really hone in on that, it's $349,000. On this next slide, we're going to go into what we're delivering this thing at. So kind of remember that 349,000 number. So here, actually, it's cut off on my screen. So Nick, you want to run through this real quick?
Yeah, no problem. So, we're able, because of some of the things we've done on the land acquisition side, land development side, and the way we're structuring the construction contract for the horizontal and vertical components, we're able to deliver the finished product here for about 223,000 a unit, which is a very attractive cost basis for a new construction BTR product like this. Most of the new construction multi in the market and BTR is coming in somewhere between 240 and 250,000 a unit. And so that's how we're getting what we'd call an outside kind of yield on cost or return on cost of a north of 7% untrended number, which is very attractive. And we'll speak to that a little bit more on the next slide. But yeah, I mean, we feel we're very excited about the cost basis here. So hopping into the pro forma projection, feel free to dig into this. And if you've got any particular questions, we could certainly have a follow-up conversation about it. But I'd ask you to pay attention to that stabilized year 3 column. and particularly that return on cost number. So that was what I was beginning to speak to before. Return on cost, yield on cost at 7.7% trended or 7.3% untrended in the stabilized column. What that really reflects is essentially, you can think about that as a forward cap rate, and cap rate is the metric that commercial real estate professionals use to value real estate. And so anytime your return on cost exceeds the market cap rate, meaning the market cap rate that investors are willing to pay for an investment, you've inherently created value. And so the bigger that spread between the market cap rate and your yield on cost or pro forma cap rate is, the more value you've created. And so in this Crestview market today, the market cap rate for this is probably somewhere around 6%. So we've got a very strong spread there between the market cap rate and that yield on cost of north of 7, meaning there's a lot of value creation opportunity in this asset.
Yep. And then on this, you can see here on our projections, you can really see your all-in cost and then your gross value created. On the fund investment return, go ahead, Nick.
Say, Shane, do you want to say something?
I was just going to say that I think that this is that exit assumption slide was the one that you wanted to highlight, the fact that even at our sale in 3 years from now, our expected sale price is still fundamentally lower than today's average home price in the market.
Correct.
Yeah, by about 15%. We're thinking about this as a build, lease up, and sell. So it is a sort of 3-year cycle on this investment. And we pegged it at, again, a 6% cap rate, essentially close to today's cap rate. Could that come in a bit? Sure, but pretty confident it will 3 years from now as that market tightens. There really isn't a lot of supply projected for that market. So, we feel like we've been fairly conservative here with how we're thinking about the back end. And really, again, that $285,000 per unit sale price, substantially below kind of where the market home values are today.
So the investment return timeline, this is here is a 25% average annualized return. It is a 3-year hold period and stabilized in 2028. I want to run through some key dates here. We have closing in December 2024. That's when we close on the land. And then we've got our construction horizontal starting here in January. And then the construction vertical will start in May of 2025. And then leasing will also start in 2025. So as Nick talked about in that kind of stabilized value, that's how we're actually doing this. So I actually spoke with the city on getting temporary certificates of occupancy. So as we build this project out, we'll have it fenced off. And as we build product and get it completed, we'll actually move the fence back, and they're going to allow us to actually move people into this project as we're completing the construction in phases all the way towards the back. So it gives us the opportunity to really start leasing way ahead of schedule of September 2026. Nick, is there anything else you would add?
No, not to that slide.
So it's time for Q&A. I know Brendan's been active in the chat because I've been seeing little red bubbles pop up, but is there anything else that you can think of that you would like to ask questions about the particular deal, particular market? You got us here. We're willing to answer any questions you have. So Brendan, if you would like to talk about some other questions that you commonly get, because you're at the forefront of talking with investors, what are some questions that you're getting right now?
Sure. Yeah, Eddie. I would say the common theme for one question, that whether it's institutional or the retail level for investors, is always track record, right? I think delivering offerings like this, PowerPoint presentation decks and webinars, it's all great stuff, but I think showcasing that you've done this before and you've been there is phenomenal as well. And that's a testament to how much capital, a GP is involving into the deal themselves and contributing. And, we're happy to say that that's a significant investment on our end for the fund. But, Eddie, I will say one thing that I'm really proud of here at Hampshire Capital after having many conversations with investors is the common theme that I've seen is their interest in communication throughout the entire investment process. I think that's one thing that separates us versus other sponsors is, we tell you the good news and we tell you the bad news. And we are sure to do that every single month, every single quarter. We're delivering monthly reports and updates. If you have a question and you ask investor relations, you get a response, within 48 hours. And, I don't think a lot of general partners are, doing that today, as, we're kind of entering a landscape that has been gloomy in the past. A lot of LPs aren't too happy with their previous investments. And, I can say based off of conversations since my arrival here at Hampshire Capital has just been great. Investors are really happy to hear things that we come back with, as well as the fact that we are transparent about all situations throughout the investment process. But that's one thing that I would say, differentiates us, and a common theme in terms of conversations that I have.
Absolutely. A pro tip for anybody that is a general partner and raising capital or thinking about raising capital in the future. I know this team has collectively raised well over $100 million collectively, and that doesn't happen without doing a good job continuously. And it doesn't mean that we haven't faced any adversity in the market. And to be able to raise capital continuously, as long as we have in this game, is that bad news doesn't age well. You just deliver it. And the best thing to do is just deliver it with honesty, explain what happened, give the data, give the facts, give the truth, and explain what you're going to do about it. Don't just tell investors, this is what went wrong and we don't know what we're going to do. Explain what we're doing to fix it. And if I could give anybody that advice, that's what it would be: is if you got bad news, if you got things going wrong, just stick to the facts, tell the truth, and then don't come with just a problem, come with a solution. Does anybody want to add anything else on the team? All right. Well, thank you all very much for taking your time out of your busy schedules, coming, hanging out with us today and talking about real estate and investing. If there's anything else you need from us at all to make this decision very easy for you, please do so. This is a very a time capsule investment, meaning the time of the sand has already been turned over and the sand's running through the bottle. So we want you to have a spot in this investment. So please, if you are on the fence, please reach out to Brendan. And this is time sensitive. So reach out to him and get anything that you need from us. We're here for you, here to support you. And if you need another follow-up call with anybody on the team, please let us know. You all have a wonderful day and a beautiful afternoon.
Thanks, everybody.
Thank you.